Because joining us now from Toronto with more on the fate of the dollar is Camilla Sutton, Director of Foreign Exchange Strategy at Scotia Capital. Ms. Sutton, welcome to Bloomberg News.
Thank you very much. It's my pleasure to be here, Mark.
And as you just heard in Sara's report, one of the Fed presidents, Mr. Bullard, saying that maybe one of the things that might happen is to keep pumping more dollars into the system. Was wondering if we might get your reaction first to his comments.
Well, I think we're at a very interesting times in terms of monetary policy overall, and no matter how we slice it up on a relative basis, the Fed continues to have very, very loose monetary policy, and as we look out in the future, that looks like it's going to continue for longer than the market had expected certainly a month ago. And I think that whether that comes from holding interest rates at these very, very low levels, or whether that comes from increasing the amount of liquidity in the system, all of that does really equal a bearish note for the U.S. dollar, and it gives it one more weight to struggle against as it tries to hang on to some stability here.
So in the short term and perhaps even in the longer term, the door is still open for continued dollar weakness.
I think that's true. I think we're in the midst here of a multi-year U.S. dollar decline, and I think that decline gets interrupted by very short periods of strength, and that one of those periods could come when the Fed does start to hike interest rates. But I think all in all, the overall decline in the U.S. dollar has not ceased, and we're still in the midst of it.
Camilla, hi. If the dollar continues to weaken, as you say, and other currencies strengthen, won't that kill off the recovery in some of these other major countries?
Well, it's true. It's a very fine balancing act for many of these countries. In fact, Canada is one great example of that. So in Canada, we have a strong Canadian dollar, a weak U.S. dollar, and that's really putting some pressure on our economy generally. And that's very true across a lot of countries. So in Japan, a very strong yen, very difficult for its economy that's already struggling. Euro, very similar story. Germany, export-oriented economy, struggling with the strength of euro. And so I think that all in all, you know, the offset is that it is difficult for these countries that are facing strong currency appreciation to continue in terms of the state we're in terms of the recovery. And I think the one exception to that is probably Australia. It has a very strong Australian dollar, yet somehow it's managing to have very robust economic fundamentals. It's one of the only countries that has escaped the recession, this global recession. So they're managing very, very well, even with a strong dollar. So it's interesting the offset between, even within the G10, the different countries there.
And moving beyond the G10 into emerging markets, we see some of the countries putting on capital controls to try to block their currencies from strengthening. Do you think that will work? In other words, do you think it will actually deter foreign investment into these emerging markets, currencies, and economies?
I think capital controls definitely work in that sense, and I think what we have seen over the last few weeks is certainly an increase in the number of rumors as well as actual capital controls we're seeing being put into place, and Brazil is one of the examples that we've seen an awful lot of after the last month. And I think that all in all that those could work. I think probably the bigger implication is what they mean for the U.S. dollar on a broader basis. So do small capital controls in some of the regional economies, do they actually matter to the broader move in the U.S. dollar? I think maybe it provides some stability, but all in all, I think it's very difficult to fight this U.S. dollar downtrend.
So is the focus now on the timing of a change in China's currency position?
Well, we've seen a lot of focus on China, certainly over the last few weeks. Probably mostly because of the Obama's visit there. However, I think, you know, all in all, what it looks like is that China needs to make some change to their currency policy. We'll probably see some appreciation from the yuan over the next year or so. And I think that some appreciation probably doesn't come as a reval overnight, probably comes as a slow move in terms of yuan appreciation that allows it to participate on the global scale in a more reasonable fashion. Right now, they have a huge advantage right now by pegging their yuan to the U.S. dollar, and that's really hurting a lot of the other Asian counterparts, and there are ramifications for the U.S. as well.
And speaking of ramifications, we're also waiting for the Fed. When the Fed funds rate goes up, is the dollar going to mimic that?
Well, I think that's the key thing, Mark. I think when the Fed actually steps up to the plate and starts hiking interest rates, I think what we'll be at is a point in the recovery where it's solid enough that the Fed thinks it can sustain it. So hopefully unemployment will have at minimum stopped rising and hopefully have begun to fall a little bit, and inflation pressures will probably be heating up. And I think that is a period where we could see some temporary U.S. dollar strength, and that's a real key, because right now what we hear over and over and over again are not only global bodies but global central banks telling us it's it's far too early to look at exit strategies. And until we hear a change in that, I think that that's an environment for the U.S. dollar to weaken.
Okay, and I wanted to touch on something in our last minute because you mentioned the jobless rate over 10%. And I was struck by something that the Republican senator from Texas, Kay Bailey Hutchison, said on NBC's Meet the Press yesterday. She said that a jobless recovery is no recovery. Do a lot of analysts agree with that sentiment?
Well, I think in terms of what we look at, and we look at the unemployment rate in terms of what the Fed will do with it, and that's part of their dual mandate. And so from that sense, we've never seen the Fed hike interest rates when unemployment rates are still rising. So in the way we look at it, I think that's probably a very fair way to put it. Without the unemployment rate beginning to fall, it's very unlikely the Fed's going to be able to hike rates.
And in our last 30 seconds, where do we see the dollar this time next year?
I think the dollar's weaker this time next year.
Really?
It depends which currency you peg it against.
Significantly weaker?
Yeah, well, we have a 2010 year-end forecast for euro of 160, so touching back up to those highs that we've seen. And, the Canadian dollar breaching through parity, the same with the Australian dollar. So, we do see that the U.S. dollar will be weaker where we close next year than when we close this year.
Our thanks to Camilla Sutton of Scotia Capital joining us from Toronto, and our Sara Eisen, our currency reporter, joining us from the newsroom. Ladies, thanks.